Top Analyst breaks down the exact date a Tesla bull run will begin. If you hold any Tesla stock, you need to watch this full video, as we'll be discussing every detail and giving our own opinions on the matter. Hello everyone, you're watching Trade Daily. Like and subscribe to get all the latest news on electric vehicles, EV stocks, and technologies. Now let's get into the news. This legendary electric automaker is head and shoulders above the competition. Stocks hit the ground running in 2023 with the nasdaq composite up by 13.6% year-to-date as outsized inflation levels off and resilient economic data suggest the economy could avoid a severe recession. While it is foolish to predict the market-specific future, it's probably safe to deduce that Tesla's stock is benefiting from these tailwinds. And I'm pretty confident asserting that the automaker's company-specific advantages will help it outperform the market over the long term. Here are 3 reasons why. Tesla now at his scale as competition is heating up in the electric vehicle industry, leading some analysts to expect near-term challenges among EV makers to match consumer demand. Tesla responded to recent pressures by announcing price cuts on some of its models. According to Reuters, the automaker slashed the sticker prices on some models by around 20%. This strategy is most evident in the Chinese market, where its cars are roughly 40% cheaper than in the US. But investors shouldn't look at these moves as a sign of desperation. Instead, Tesla is demonstrating the power of its scale, showing that its circumstances allow it to make such moves and remain competitive. That suggests the company has a deep economic moat. Tesla is profitable, as in full year 2022. Tesla's operating income more than doubled to $13.7 billion. This number puts it head and shoulders above pure-play rivals like Lucid and Rivian, which both lose money in their operations. As a profitable company, Tesla has a lot of room to keep prices lower for longer to maintain and grow its market share. And it is less dependent on external financing, which creates a debt to manage. That's a powerful advantage right now as financing has become more expensive with the sharp rise in interest rates. Tesla's valuation is still reasonable with a market cap of $623 billion. Tesla is not a small company. In fact, it's worth more than every other American automaker combined. From a valuation perspective, the stock's forward price-to-earnings multiple of 48 is significantly higher than those of traditional rivals like Ford Motor Company or General Motors, which have P/Es of 7.5 and 6.7, respectively, despite large sales volume and an ambitious transition to EV. Still, Tesla's valuation isn't as astronomical as it seems on the surface. As a pure-play electric automaker, Tesla should be valued in the same way as traditional car companies transitioning to the technology. These companies will likely cannibalize their existing gas-powered lineups with EV alternatives, while Tesla enjoys pure growth. Tesla's relatively good growth expectations help further justify its valuation. Management expects vehicle deliveries to grow by an average compound annual growth rate of 50% over the long term. This could translate to significant revenue and profit growth. Is the stock still a buy? After soaring 58% year-to-date, Tesla stock is no longer as cheap as it was at the start of 2023. Leading analysts like Morgan Stanley's Adam Jonas to conclude that investors may have missed their window of opportunity to buy the stock at a compelling valuation. But a long-term investment strategy is the key to sustainable returns in the stock market. And despite the higher price tag, Tesla still looks like a buy when considering where it could be 10 years from now, and not just 10 months from now. A bull market is coming, so here are 2 growth stocks to buy and hold forever. Tesla remains the best way to bet on the electric vehicle industry. Membership Collective boasts an impressive economic moat. Tesla and Membership Collective Group look poised for explosive long-term growth. It's impossible to predict the stock market, but there are many reasons to be optimistic. With inflation falling and the labor market still strong, many economists are starting to expect a soft landing instead of a major recession, which could be good news for equity valuations. Let's explore why Tesla and Membership Collective Group could be great ways to bet on the next bull market. Tesla. Up by 82% year-to-date, Tesla stock has hit the ground running in 2023. The legendary electric vehicle maker lost much of its value last year because of valuation concerns and possible saturation in the EV market, but the company's growth potential remains stellar, and its deep economic moat can help it keep the competition at bay. Competition is heating up in the EV industry, with legacy automakers like Ford Motor and General Motors racing to develop electrified models. But from an investor's perspective, Tesla remains an ideal way to bet on this opportunity because it enjoys pure growth in the market, while its large rivals are cannibalizing their existing internal combustion engine businesses. Further, Tesla is shielded by its size and profitability, which can help it outcompete smaller, pure-play EV competitors. With high interest rates impacting consumer purchasing power, EV makers are turning to price wars to maintain or capture market share. According to Reuters, Tesla has reduced its prices by 20% globally. But with a third quarter operating profit of $3.6 billion, Tesla is much better positioned to survive pricing competition than rivals like Lucid Motors, which burned through $687.5 million in its most recently reported quarter, while Rivian lost $1.77 billion. Higher interest rates also increased the cost of external financing, making it even harder for Tesla's unprofitable competitors to keep up. Membership Collective Group, founded in 1995 and publicly traded since 2021, Membership Collective Group is a luxury hospitality company known for its flagship private members club, Soho House, which started in London before expanding globally. Shares have roared 28% year-to-date and could rise further as the company positions itself for long-term profitability. Membership Collective Group stands out because of the massive pent-up demand for its services. As of the third quarter, total members grew by 46.3% year-over-year to 211,351, and the waitlist for new members increased to an impressive all-time high of roughly 85,000. Private membership clubs rely on their exclusivity to maintain their quality and appeal. Unlike many such organizations, which often operate just a single location, Membership Collective's Soho House seems to have monetized its luxury experience on a global scale, while still keeping that precious sense of scarcity that made it so successful. The result is a business that looks capable of controlling the rate at which it grows and possibly enjoys significant pricing power yet to be exploited. Total revenue jumped 48% year-over-year to $266 million. And while the company generated an operating loss of $70.6 million, adjusted earnings before interest, taxes, depreciation, and amortization jumped from $8.8 million to $20.2 million after adding back non-cash charges such as share-based compensation, severance expense, and an eye-watering $53 million in foreign exchange losses. This loss was likely due to the appreciation of the dollar against European currencies and is unlikely to be replicated. Which stock is best for you? Tesla and Membership Collective are excellent ways for investors to capitalize on a potential new bull market in stocks, but they serve different investment strategies. As a large and profitable company, Tesla is probably the safer bet. That said, with its small size, the Membership Collective could have more room for long-term growth, especially as it transitions to profitability. And with that, ladies and gentlemen, we come to the end of the news. Like and subscribe to stay up to date with all the Tesla news. But just before we go, I'd like to remind you that this video is for news and entertainment only and should not be used as investment advice.